Every financial crisis looks different on the surface, but underneath, they all begin the same way. Not with panic, not with crashes, but with signals almost everyone ignores. Welcome to Willickson, where history isn't just remembered, it's used to understand how money, power, and systems quietly break. Every major financial crisis is remembered for its ending. The crash, the collapse, the headlines, the panic. But history shows something far more uncomfortable. Crises don't begin when markets fall. They begin when markets look calm. Long before panic appears, long before prices collapse, the same early signals repeat again and again, across centuries, across countries, across completely different systems. If you only study the moment of collapse, everything looks unpredictable. If you study how crises actually start, the pattern becomes impossible to ignore. Applied financial history is about understanding that beginning, because by the time panic arrives, the outcome is already locked in. The first stage of every financial crisis is credit expansion without corresponding real growth. This is where almost all collapses quietly begin. Easy money, low interest rates, loose lending standards, rapid expansion of credit. At first, this feels positive. Growth accelerates, asset prices rise, unemployment falls, confidence builds. But underneath that surface optimism, something structural changes. Debt begins to grow faster than the economy's ability to service it. This happened in the United States before 1929, when margin debt allowed investors to buy stocks with borrowed money far beyond what incomes could support. It happened before 2008, when mortgages were issued to borrowers whose cash flows could never realistically cover long-term obligations. It happened in Japan before its asset bubble collapsed in the early 1990s. It happened in emerging markets before debt crises. The pattern is always the same. Credit grows first, reality follows later, or never. At this stage, nothing looks broken. In fact, everything looks healthy. And that is precisely why it's dangerous. The second signal always follows quietly. Asset prices disconnect from underlying income and productivity. Homes rise faster than wages. Stocks rise faster than earnings. Land prices rise faster than rent. Entire markets begin to price growth that has not yet occurred and may never occur. This isn't speculation in the dramatic sense people imagine. It's institutional optimism. Banks assume tomorrow will look like yesterday. Investors assume liquidity will always exist. Governments assume growth will eventually catch up. But history shows that when assets inflate faster than the income that supports them, the system becomes fragile, not immediately, but structurally. In 1929, stock prices surged while wages lagged behind. In 2006, home prices exploded while household incomes stagnated. In countless sovereign debt crises, government obligations expanded faster than tax bases. At this stage, warnings exist, but they are subtle. They don't scream collapse, they whisper imbalance, and whispers are easy to ignore. The third early signal is policy denial. This is where institutions begin defending stability instead of questioning it. Central banks reassure markets. Governments downplay risk. Media focuses on short-term growth metrics. The message becomes consistent. This time is different. The system is resilient. Concerns are overblown. History shows this phase clearly. Before the Great Depression, officials repeatedly insisted that markets were fundamentally sound. Before the 2008 crisis, regulators described housing risk as contained. Before currency collapses, governments denied devaluation risks. This is not incompetence. It's institutional inertia. Large systems are built to preserve confidence. Admitting fragility too early can cause the very panic leaders hope to avoid. So reassurance replaces reform, and the imbalance deepens. The fourth signal is complexity replacing transparency. As systems strain, complexity increases. New financial instruments appear. Risk is repackaged. Exposure is redistributed rather than reduced. This happened with mortgage-backed securities before 2008, with derivatives layered on sovereign debt, with structured products that appeared to spread risk but actually concentrated it. Complexity gives the illusion of control. When risk becomes difficult to measure, it feels safer. Not because it is safer, but because it is harder to see. History shows that systems become most fragile when participants can no longer fully understand how they function. At that point, trust replaces understanding, and trust is fragile. The fifth signal is moral hazard becoming normalized. Participants begin to believe that failure will be managed rather than allowed. Banks assume bailouts. Investors assume intervention. Governments assume central bank support. This changes behavior. Risk increases because consequences feel distant. Before 2008, financial institutions assumed they were too big to fail. Before sovereign debt crises, governments assumed refinancing would always be available. Once this belief sets in, discipline erodes. Risk is no longer priced accurately. It is postponed. History shows that this stage dramatically accelerates collapse once conditions change. The sixth signal is early stress appearing outside the spotlight. Not everywhere at once, only at the edges. A few lenders fail, a regional market cracks, liquidity tightens in obscure corners. These events are dismissed as isolated. Before the Great Depression, smaller banks failed first. Before housing collapsed nationally, specific regions showed stress. Before currency crises, black markets reflected reality before official rates did. Early fractures appear where protection is weakest, but because the core still functions, the system appears stable. This is the most deceptive phase. The seventh signal is intervention replacing resolution. Rather than addressing the imbalance, authorities attempt to manage outcomes. Rates are adjusted, rules are modified, liquidity is injected. These actions delay collapse, but they do not remove its cause. History shows that interventions often make the eventual adjustment larger, not smaller. By extending imbalances, they increase the distance between paper stability and physical reality. And when that gap finally closes, it closes violently. Only after all these stages does panic arrive. And panic is always remembered as the cause, even though it is merely the symptom. People remember bank runs, market crashes, unemployment spikes. But by then, the crisis has already matured. The outcome was decided years earlier. This is why financial crises feel sudden to the public, but obvious in hindsight. The signals were there. They always are. But they don't appear where people are trained to look. They don't appear in daily price movements. They appear in relationships, debt to income, assets to productivity, complexity to understanding, confidence to reality. Applied financial history teaches one uncomfortable truth. Crises are not unpredictable. They are ignored. This doesn't mean collapse is constant or inevitable tomorrow. It means systems follow rules, whether we acknowledge them or not. Ignoring those rules doesn't break them. It only delays their enforcement. The reason this pattern keeps repeating is simple. Modern economies prioritize growth, confidence, and liquidity, but they depend on trust in structures that are inherently fragile. When paper claims expand faster than real capacity, the system must eventually reconcile the difference. That reconciliation is what history records as crisis. Understanding how crises start doesn't make someone immune to them, but it changes how events are interpreted. Instead of asking, why did this happen? You start asking, how long was this forming? And that question leads to clarity, not panic. This is the real value of applied financial history. Not prediction, not fear, but perspective. Because systems rarely collapse without warning. They collapse after warnings go unheeded. If you want to understand financial crises before panic sets in, subscribe to Wheelixon.